So, very good evening, friends. Today, we'll have a discussion on this introduction to trading, clearing, settlement, and risk management on stock exchanges. I've shared some MCQs also on the subject. Those who are dealing in shares either on a professional basis or on individual basis may be aware of the basics of stock market. And this is what is contained in this chapter. Basically, it starts with the trading mechanism and it explains how this trade takes place on a stock exchange. So, trade means either you want to buy or you want to sell the shares. So, it starts like this. A securities trade's life cycle starts with the placing of order on the exchange. Suppose you want to purchase certain securities or you want to sell certain securities which are with you. And so first of all, you have to place an order on the exchange. Its conversion into a trade, and finally, the trade being settled after securities or funds pay in and pay out. Because all this system has to be foolproof because most of the things these days are online, and because the stock exchanges are also in picture, the stock brokers they are also in picture. So they have to ensure that the dealing takes place and the buyer and the seller are not known to each other. So there has to be a system by which this mechanism works on its own. So that is the basic idea. So it says its securities trade life cycle starts with the placing of the order on the exchange. Second is its conversion into a trade. And finally, the trade being settled after securities or funds pay in and pay out. Suppose you want to purchase securities of a company, there may not be any seller. So it may not ultimately convert into a trade. You have just to place the order, but there's no party on the other side. You want to sell your shares, but there's no one to buy. Similarly, you want to buy, but there is no one to sell. So in that case, it will stop at the first stage itself. So first of all, first stage is placing of the order, then its conversion into a trade, and then there are certain precautions also, which the system takes place, which the system takes care. Suppose you want to sell shares, so then it will check whether you have got the adequate quantity in your demat account. Similarly, if you want to buy certain shares, then whether adequate money is there in your bank account. So this much precaution is taken at the every stage of the trade so that there is smooth transitioning from one process to the other. So securities trade life cycle starts with the placing of the order on the exchange, then its conversion into a trade, and finally the trade being settled after securities or funds pay in and pay out. The pictorial representation of the securities trade life cycle from the broker's point of view is given in this. So this is given from the broker's point of view because it is the broker who has to get it executed. So first of all, you will place the order because the broker is the person with whom you are in direct touch. You are not directly in touch with the stock exchange. The stock exchange may not be even yours in your city. Even the broker may or may not be in your city. But because you are trading online, but you have opened an account with that bank. Suppose you want to say purchase something, so then you have to be in touch with the shopkeeper. So similarly, the broker is the person who is helping you in executing your orders. It may be either a buy or a sell. So place order, you have to place order through the broker, then the trade is executed. Then trade confirmation or contract note comes and clearing and settlement of trade, and then you will receive funds or securities. You will receive funds in case you want to sell your securities, or you will get securities in case you want to purchase securities. So it can be seen that the flow starts from placing order with the client, and the order is entered into the system is matched with a specified order type. So order types have been explained later in the section, that buy and sell. And the trade is supposed to be executed. The stock market systems are such that once the trade is confirmed, intimation is automatically sent to the depository participant and the clearing banks for pay in or payout of the funds and securities. So we have already understood the concept of depository participant in chapter 1. So can anybody tell who is a depository participant?
The buyer or the seller?
No, basically the banks where this who keeps it with.
Because my DP number will be there.
Okay, it's the securities in.
I think you can refer to page number 28. 28 of the study material. Let me go to page number 28.
NSDL CDSL.
Right. So this is the market infrastructure. This we have already studied in the earlier class. So depository is an entity facilitating holding securities in electronic form, and it enables transfer of securities by book entry. The main objective of depository is to provide maintenance of ownership or transfer records of securities in an electronic book entry form. So there are two depositories in India, CDSL and NSDL. And the depository that provides its services to investors through its agents called depository participant. Okay, so there is a difference between a depository and a depository participant. So depository participants are agents basically of depositories. There are only two depositories, CDSL and NSDL, and the depository, they provide the services to investors through its agents called depository participant. So now I think the definition is clear. Let us again move to where we were. I am deliberately going a bit slow so that you can follow the things. So the stock market system are such that once the trade is confirmed, intimation is automatically sent to the depository participant and the clearing banks for paying or payout of the funds and securities. When the investor who has sold the securities has received the funds against it and the investor who has bought and vice versa, we say that the particular trade is cleared and settled. So first of all, you place an order, then there is checking in the system whether the other party is available or not. In case the other party is available, the trade is executed. The next point to ensure is to pay in and pay out of the funds. So that is ensured through the clearing banks. The Indian securities market currently follows a T+2 rolling settlement. So the date of the trade plus 2 days. Sometimes it is 1 day, sometimes it is more also. So however,
T1 हो गया.
हाँ
अभी T1 है T1.
हाँ ठीक है हाँ ये इनका NISM की साइट पे दे रहे हैं अपना जो भी है दे रहे हैं. Our T+1 rolling settlement is also being introduced in a phased manner, starting with a select few securities. So there is a separate settlement cycle for government security. क्योंकि क्या होता है राजेश जी, कई बार ये हो सकता है ना कि कुछ स्टॉक एक्सचेंजेस में या कुछ सिक्योरिटीज में अभी भी T2 चल रहा हो. पॉइंट ये है.
नहीं सर नहीं, अभी ये पीछे ही कुछ दिन पहले ही हुआ है.
ओके हाँ. तो अभी कहीं पर भी T2 नहीं है.
नहीं T1 है सर.
From 27th January, it has been done to T+1.
Okay.
डेट मुझे नहीं ध्यान, लेकिन अभी
अच्छा,
हुआ.
from 27th January. Okay.
Yes.
Okay.
But for the examination point of view, if it is written T+2, then we have to pick T+2.
It says that okay, earlier T2 was there, but now T+1 is also being introduced in a phased manner, and they have started with the select few securities. So there is a separate settlement cycle for government securities. So for government securities, this is not the procedure. So it is something else, T+7, something like that. In the below section, we elaborate on how a client's order moves in the exchange system and gets converted into a trade. So now we have understood the basics कि कैसे इसका trade होता है. ठीक है. So first of all, the placing of the order. Now, when a client places a buy order with the broker, so there could be two types of orders, either a buy order or a sell order. So when the broker receives a buy order from a client, either by phone or through internet banking, the broker system first checks whether there are sufficient funds in the client's account, because you are trying to buy securities. So buying means you have to pay also. So the broker system, they will check whether there are sufficient funds in the client's account. The order will only be sent to the exchange for execution if there are sufficient funds in the client's account. Otherwise, the order will be rejected by the broker system. So, in case you want to buy, there should be sufficient money. Suppose you are going to a market, then you must have sufficient cash in your pocket, or you must have some credit card or something, some mechanism by which you intend to pay. So, similar is the situation here. If you want to place a buy order, the system will ensure that, okay, you have got sufficient funds in the account. Next is when a client places a sell order. Now, in this case, you need not have money, but you should have the securities with you. So when the broker receives a sell order from a client, the broker system first checks whether there are sufficient securities in the client's demat account. So suppose you want to sell shares of a particular company, then those shares must be lying in your demat account. This much has to be ensured. The order will only be sent to the exchange for execution if there are sufficient securities in the client's demat account. Otherwise, the order will be rejected by the broker system. In such a scenario, the broker shall verify with the clients as a prudential measure. Now, order matching. Now, first thing is ensured. Buy money, sell securities. Now, second process is order matching. On receiving the order, the exchange will send an order confirmation to the broker's system. And the order is matched with a suitable counter order. If you want to buy, then it will check whether there is a corresponding seller. If you want to sell, it will check whether there is a corresponding buyer. If a counter order is found, the order is executed and the trade confirmation message is sent to the broker's system. If the order is not matched, then it lies in the order book in case of limit order, or it is cancelled in case of immediate or cancel order. So there could be a situation that, okay, you wait till certain time or till certain price, or you either execute it immediately or you cancel it. So depending upon those instructions, it may keep lying in the order book. Next is the order management. The order management consists of entering orders, order modification, order cancellation, and order matching. So the main components of an order are: first is the client identity, second is the price, then is the time, then quantity or number of contract, security oblique contract, what to buy and what to sell, then is the action, whether you want to buy or sell. So these are the things which you have to specify. So a trading member can enter various types of orders depending upon his or her requirements. The order conditions are broadly classified into three categories. So price related conditions, then time related conditions, and quantity related conditions, which have been discussed in the following section. So basically these are three things. So price related, at what price you want to buy or sell, or okay, I don't want to sell below this price, or I don't want to buy beyond this price. So all these conditions could be specified. Then there could be time related conditions that, okay, you execute it immediately, or you can get it executed as and when the opportunity comes. And then there could be quantity related conditions. Okay, I want to buy this much stock, but at this price only. So some quantity may be available at a lower price and some quantity may be available at a higher price. So all these things have to be seen. Then there are different types of orders. First is the market order. A market order is where a trader purchases or sells their security at the best market price available across the market depth to complete the order quantity. So this is the market order. Okay, whatever is available in the market, you will get the best. So the trader will purchase or sell the security. Now you might notice that earlier we were discussing the client. So client is the person who is intending to buy or sell. Now the second person has entered. Second person is the trader. So trader is not the client who is intending to buy or sell. So trader is a trading member basically. So a market order is where a trader purchases or sells their security at the best market price available across the market depth to complete the order quantity. So in the market order, there is no need to specify the price at which a trader wants to purchase or sell, because market conditions will determine, okay, he will say that, okay, I want to sell or purchase. So best price will be available. So there are two variations on the market order. market order without protection, that you buy or sell at whatever price is available, and market with protection order. The market order without protection means that the trades are executed at the best available prices in the market at that point in time. And everything is online, so everything is visible, there is transparency. The second type of market order, that is market with protection order, wherein it allows the market order to be executed till a specified level mentioned by the trader. So there are two types of market order without protection and market order with protection. Second type of order is limit order. So limit orders is when the trader sets the entry or exit price and then aims to buy at or below the market price or sell at or above it. Because if you want to buy, then definitely your intention will be to buy at the minimum price. So you might specify the maximum price at which you want to buy. That okay, you buy at this price or lower than that. If you want to sell, then naturally the tendency will be to sell at the highest price. So you will say, okay, you sell at this price or above it. So this is the limit order. So limit order is when the trader sets the entry or exit price and then aims to buy at or below the market price or sell at or above it. The trader needs to specify the price. So reaching these limits or targets is not always possible, and sometimes the orders do not go through. So that concept we have already seen, that the order, they will remain in the order book. So limit orders are very common for online traders, that okay, you specify the price also, that okay, don't buy beyond this point or don't sell below this point. Third type of order is stop order. The type of order that allows the trading member to place an order which gets activated only when the market price of the relevant security reaches or crosses a threshold price. So this is the stop order. So until then, the order does not enter the market. So in case that okay, this order will be activated only when the market price of the relevant security reaches or crosses a threshold price. That okay, if I want to sell, but I would like to sell only when it crosses say 500 mark or 5,000 mark. Or I want to buy, but I will buy when the price falls below say 1,000 mark. So this is the stop order which gets activated only when the market price of the relevant security reaches or crosses a threshold price. Now, what could be the difference between this market order without protection and stop order? In the market order, the instruction is basically to buy or sell immediately, but only precaution is the price availability. But in case of stop order, the order is not activated immediately, but the order gets activated only when the security reaches or crosses a threshold price. So this is the basic difference between market order and stop order. Suppose you want to sell Reliance. Okay, now you might say that okay, I want to sell Reliance, but once it crosses say 5,000. So this will be a stop order because the activation will be done. Today the price may be 2,000, but if you want to sell at 5,000 and above, then you might say that okay, the order will get activated only when the price reaches or crosses a threshold price, basically. So in stop order, the client enters two prices. One is the trigger price and the other is the limit or market price. So this stop order, it will include two things. One is the entry, the trigger point, and the other is the limit or market price. So a stop order can best be explained with an example. Suppose a trader has a short term, say for a day, bullish view on a stock, that okay, he feels that this stock will go up. Bullish means that okay, you are expecting that it will go up, and bearish means you are expecting that it will go down. He may buy the stock at say 100 rupees per share in the early hours of trading session. He entered the market at say 10 o'clock or 9:30, and he bought a certain stock at 100 rupees per share. Now, if the stock price moves upwards as per his expectation, he may sell the stock say at 110 and close his position. The stock price can also move downwards because he was expecting that okay, it will go up, but it may go reverse way also. He was expecting that it will go up, but it goes down. It goes down even below 100. So If the stock price moves upwards as per his expectation, he may sell the stock, say at 110 and close his position. The stock price can also move downwards, much against expectations of the trader. It may so happen that the trader may have limited risk appetite and doesn't want to incur loss of more than, say, rupees 5 per share. So in such a scenario, a trader can give a stop loss sell order with trigger price of 96 and limit price of rupees 95. So there are two things. One is the trigger price. Trigger price is okay. You offer when the price reaches 96 or when it goes up to 96 and limit price of rupees 95. So when the stock price starts moving downwards, as soon as it hits the price of 96, the sell order of rupees 95 will automatically get triggered. And okay, this security is available for 95. Any further downward movement in price will not affect the trader as he has already limited his loss on the position, stop loss. ठीक, तो इसने कह दिया कि भैया इससे कम पर नहीं. A buy order in the stop loss book gets triggered when the last traded price in the normal market reaches or exceeds the trigger price of the order. So buy order will naturally, because you might like to buy at the lowest price. So buy order in the stop loss book gets triggered when the last traded price in the normal market reaches or exceeds the trigger price of the order. That okay, I don't want to buy above this price. Next concept is immediate or cancel order. Either you do it immediately or you cancel my order. I don't want to wait. So IOC, an immediate or cancel order allows a trading member to buy or sell a security as soon as the order is released into the market, failing which the order will be removed from the market. So partial match is possible for the order. You want to buy 500 securities, but say 100 only are available at the price at which you are mentioning. So it may be partially matched and the unmatched portion of the order is cancelled immediately. So this is the concept of immediate or cancel order. Then order routing process through exchanges. Now we have got some basic idea as to how the stock moves. Those who are trading on a daily basis, they may be having much more clarity, but there may be some participants who have not dealt in the stock market. There are persons like me who have never dealt in stock market. So order routing process through exchanges. So once the order is entered and confirmed by the client or dealer at his trading terminal, the order is routed to the exchange for its execution. So now we are confirmed about the quantity, we are confirmed about the price at which we want to buy or sell. Now next step is order is entered and it is confirmed by the client or dealer at his trading terminal. The order is routed to the exchange for its execution. The exchange system allows a unique order number because it has to be identified also. The exchange system allows a unique order number for all orders received in the system, and this is given as order confirmation along with a timestamp to the broker system. And the order matching in an exchange is done based on the price time priority. So this is done based on the price time priority. The best price orders are matched first. If more than one order arrives at the same price, so they are arranged in ascending time order. Best buy price is the highest buy price amongst all orders, and similarly best sell price is the lowest sell price of all the sell orders. So let us take an example here to better understand this. A sample of the order book is given below for understanding. So this is the sample order book. Suppose these are the quantities at which someone wants to buy. So buy quantity of 50, if you buy 50 at this price. If the price goes down, then you buy 100. If the price goes further down, then you buy another 25. If the price goes further down, then 500. And if the price goes up to 120, then you buy 500. Similarly, sell quantity 50, you sell 50 securities at the 121.50. If the price goes up, then I'll be able to offer more securities. If the price goes further up, then further. So similar things like this. So these codes given in the table above are visible to clients. That okay, this much quantity is available at this price, this much sell is available at this price. Now, if a buy market order comes with an order quantity of 50, it will get executed for a price of 121.50 because best buy, best sell. X is intending to buy 50 shares of a particular company. He wants to buy at 121.20, but the other person is intending to sell it at 121.50. So this will get executed at 121.50. And the order book entries on the sell side moves up by one notch. That is, now the next quantity is available at 121.80 because only 50 shares were available at 121.50. But now suppose he wants to buy more. So those another 200 shares, they are available at 121.80. And the order book entries on the sell side moves up by one notch. That is rupees 121.80 order comes to top. On the other hand, if a limit order with a sell price of 121.20 for a quantity of 500 only 50 shares get executed. Suppose there is a person who wants to buy at say 121.20, but only 50 shares are available. So in this case, the order only 50 shares will get executed and the order for remaining 450 stays at the top on the sell side at rupees 121.20. So first of all, best matching is done. And the order matching, it is done in the order in which it is received on time basis. So the order matching is done based on the price and time. So they try to match the price and the time. And the best price orders are matched. And it is all done through computer. So if more than one order arrives at the same time, they are in an ascending time order. And best buy price is the highest buy price amongst all orders. And similarly, best sell price is the lowest price of all sell orders. Now in this case, what is the best sell price? The best sell price is 121.50 and the best buy price is 121. Best buy price is 120.
120, sir.
120. Best buy price will be 120 and the best sell price will be 121.50. But it may be another matter that, okay, the quantity which you want to buy at this price may not be available. So depending upon that situation, the order might be partly executed and not fully executed. So these codes given in the table above are visible to client. Okay, this I explained. Now all orders come as active orders into the order book. So normally all orders are active orders. So if they get a match, they will be executed immediately, else they will be entered into the order book according to price and time as passive orders. Next point is order modification and cancellation. The orders once placed in the system can be modified or cancelled till they are matched. Suppose you wanted to buy at a particular price, but securities are not available at that price. So in that case, you may like to modify or cancel your order. So the orders once placed until they are executed, so they can be modified or cancelled till they are matched. The screen available to a trading member displays icons that represent functions such as order modification and order cancellation. So brokers can modify or cancel orders according to the instructions of the client. So once order matching is complete, no modification or cancellation is possible because that matching has already been done. So modification or cancellation can be done only before the order is matched or the matching is not complete. So once order matching is complete, no modification or cancellation is possible. So sometimes in a moving market, orders need to be changed in terms of the price and quantity as per the client's requirement. So all the orders can be modified till the time they are not fully executed. So suppose orders which are partly executed, so only the open or the unexecuted part, naturally, only that part can be cancelled or modified. The part which has already been executed cannot be cancelled or modified. Next is the clearing, settlement and risk management. Because now you have entered the system. Client is involved, the trader is involved, clearing house is involved, clearing bank is involved. And there might be certain inherent risks also in this clearing and settlement process. So how those risks are managed? Because you might have heard terms like bad delivery, and all those things. So let us understand the clearing and settlement process, what it is actually. So the clearing function of the clearing corporation is designed to work out first what trading members or brokers are due to deliver and what trading members or brokers are due to receive on the settlement date. In the clearing corporation, this is done by a process called multilateral netting. So this process is performed by the clearing agency, clearing corporation or clearing houses. The clearing agency guarantees that all contracts which are traded will be honored. So the clearing agency, it is the responsibility of the clearing agency to ensure that all the contracts which are traded will be honored. So clearing is the process of determination of obligations, after which the obligations are discharged by settlement. A multilateral netting procedure is adopted to determine the net settlement obligation, delivery oblique receipt position of the clearing members. Accordingly, a clearing member would have either pay-in or payout obligation for funds and securities separately. Is it okay? In net, you have to pay say 10 crores or you have to deliver this much securities. So there will be either pay-in or payout obligations for funds and securities. So settlement is a two-way process which involves transfer of funds and securities of the settlement date. So clearing corporation have also devised mechanism to handle various exceptional situations, like suppose security shortage is there, bad delivery is there, then company objections or auction settlement. So can anybody tell me what could be the company objection? Because there are regulations in the market. So at times company objects that, okay, this person wants to buy, but we don't want to sell to this person. So company objections could be there because he may be trying to acquire the company, and there could be then substantial acquisition and takeover regulations come into play. Next is the settlement process. So in the Indian equities market, SEBI has given options to exchanges or clearing corporations to settle trades on trade plus one oblique trade plus two basis. In case of T plus 2 ruling settlement, a transaction into on day zero is the date of the transaction. It has to be settled on the day T plus 2 working days. So 2 working days are there, holidays, then national holidays, gusted holidays, all the stock exchange holidays, they are all excluded. So T plus 2 working days when the funds pay-in or securities payout takes place. For instance, trades taking place on Monday, they are settled on Wednesday. Tuesday's trades, they are settled on Thursday and so on. Hence, the settlement cycle is the period within which the settlement is made. And for arriving at the settlement day, or wherever there are intervening holidays, suppose bank holidays there, exchange or clearing corporation holidays there, Saturday and Sunday, they are excluded. Next is the clearing banks and their functions. So clearing banks, they act as an important intermediary between the clearing member and the clearing corporation. So they are an important link. Every clearing member need to maintain an account with any of the empaneled clearing banks at the designated clearing bank branches. And the clearing accounts are to be used exclusively for clearing and settlement operations. It's the function of the clearing members to ensure that the funds are available in his account with the clearing bank on the day of pay-in to meet the funds obligations. And in case of a payout, clearing member receives the amount on payout day. So all transactions of pay-in and payout of funds are carried out by these clearing banks. The pay-in obligations details are passed on to the clearing banks by clearing corporation, who then debits the clearing member account, and based on payout instruction from clearing corporation, the clearing bank will credit the receiving member clearing. In the case of cash market, this happens on T plus 2 and or T plus 1 day. The clearing banks, they are required to provide the minimum services as specified by the clearing corporation to clearing members. So there are roles are defined, clearing banks, and which are the important link between the clearing member and the clearing corporation. Next is the role of custodians. So custodians, they are institutional intermediaries who are authorized to hold funds and securities on behalf of large institutional investors. Suppose you are an individual, then you may be trading on your own. But if you are a bank or an insurance company, so that role might be assigned to a custodian. So custodians are the institutional intermediaries who are authorized to hold funds and securities on behalf of large institutional investors such as banks, insurance companies, mutual funds, and foreign portfolio investors. So they settle the secondary market trades for institutional investors. Several custodians are also clearing members and clearing banks of the exchange and manage both funds and securities settlement. So they are performing twin role, managing the funds and the securities settlement. Next is the settlement obligation. So clearing corporation receives the details of the trades and prices from the exchange. Settlement obligations are computed using predefined methodology specified for the segment or product. So I'll try to make a flow chart of all these processes and I'll post it in the group tomorrow morning. And I will request all the members to prepare or to attempt to prepare a flow chart describing all this process in one single flow chart. Next, because sometimes it will become easier to understand if you explain it by way of flow chart. Now, this clearing corporation, it receives the details of trades and prices from the exchange. So settlement obligations are computed using predefined methodology specified for the segment or product. Next is risk management framework. Now, because there are inherent risks like bad delivery or refusal by the company. So in that case, how this risk management is mitigated? A comprehensive risk management framework is the backbone of the clearing agency or corporation houses. A clearing corporation or clearing house, it provides settlement guarantee that the settlement of securities and funds will take place even if there is a failure by a broker or clearing member to fulfill their obligations. In order to safeguard against such failures, the clearing agency is required to carry out the risk management measures as specified by SEBI through its various circulars. So, various circulars have been issued by SEBI as to how this risk will be mitigated, and we would try to study some of these circulars also. Neelam, thoda आवाज कम कर दो, please. In the equity market segment, brokers should have a prudent system of risk management to protect themselves from client default. So there should be a system that, okay, if the client defaults, then also the risk is minimized. So margins are an important element of such a system that, okay, you place an order, but you don't have sufficient funds. So then your margin might be forfeited. The margins for this purpose, shall mean VAR margin, extreme loss margin, mark-to-market margins, delivery margins, special or additional margin, or any other margin as prescribed by the exchange to be collected by the trading member or clearing member from the clients. Because that margin will ensure that, okay, the loss which occurred to the other party is met. So clearing corporations risk containment measures include capital adequacy requirements of members. Suppose a member does a default, so how that will be managed? So these clearing corporations and risk containment measures include capital adequacy requirements of members, then monitoring of members' performance and their track record, then stringent margin requirements, position limits based on capital, online monitoring of members' positions, and automatic disablement from trading when limits are breached. So these are some of the inbuilt measures which try to mitigate the risks associated with this process. Next in the line is the role of the clearing corporation. When a trade occurs on the stock exchange, it is a legal contract between the buyer and seller. So if there is a default by either the buyer or the seller, the counterparty to the trade will have to bear the loss. So it is the other party which will have to bear the loss. So clearing corporations, they ensure that members meet their funds or security obligations. So it is the responsibility of the members. It is not the responsibility of the client, because the member knows the client, but the clearing corporation doesn't, it is not directly in touch with the individual who is trading. So this clearing corporation, it ensures that members meet their funds or security obligations. It acts as a legal counterparty to all trades through the process called novation. So this process is called novation. So there is a third party guarantee in a way by the clearing corporation that okay, whatever is the trade will be fully honored. Thus, clearing corporation becomes the buyer to every seller and seller to every buyer. So in a way, it is providing third party guarantee. So if there is a default in this scenario, clearing corporation being counterparty is responsible for ensuring the settlement, thus managing risk and guaranteeing settlement to both the parties. In a multilateral netting scenario, when a default occurs, it is difficult to unwind the trade to find the original counterparty who will have to bear the loss. So the process of novation addresses this risk because every time clearing corporation enters. So in India, in the equity segment, there are three clearing corporations, namely NSE Clearing Limited, Indian Clearing Corporation Limited, and Metropolitan Clearing Corporation of India Limited. Next is the auction of securities. An auction is resorted to when there are shortages in delivery by a seller broker. So this mechanism is utilized by the clearing corporation to fulfill its obligation towards the buying trading members. So thus, when the selling broker fails to deliver the shares, the clearing corporation through the stock exchange system conducts an open market purchase by way of an open auction, and the shares bought through the auction are delivered to the buying broker and adequate penalties are levied on selling brokers, those who could not fulfill their obligations. Now, these are the 4 sample questions, but they are sample questions only. So let us look at first these sample questions and then we'll have a look at the questions which I have already shared in the group in the morning. So market orders are of how many types? So there are 2 types of orders. What type of orders are there?
Limit order and stop order.
3 types.
Manjil? Any other option?
No. With security and without security.
Any other option?
With protection order or without protection order?
Yes.
What if I say buy and sell? In case of limit order, the trader needs to specify the price at which the trade needs to be executed. So in case of limit order as we have already seen, which is given on page number 48, and it says that limit order is when the trader sets the entry or exit price and then aims to buy at or below the market price or sell at or above it. The trader needs to specify the price. Reaching these limits or targets is not always possible, and sometimes the orders do not go through. So limit orders are very common for online traders. So in case of limit order, the trader needs to specify the price at which the trade needs to be executed. And who is the trader? So what do we mean by trader here?
The investor,
No,
the client.
No.
trading member.
Trading member.
Yes, trading member of the stock exchange. And we have already seen this definition. So first is the client and then is the trading member. Because the trading member is in the picture. Because the clearing house knows the trading member only. They don't know the client individually. So there is a privity of contract between the client and the trading member, the stockbroker basically. Third is the custodians, they are institutional intermediaries, as we've seen that, okay, in case of banks, insurance companies, they may not be trading on their own. So they are having institutional intermediaries who are authorized to hold funds and securities on behalf of large institutional investors. And sometimes these banks, etc., they may be performing twin functions. So these intermediaries
Custodians.
hmm?
Custodians.
हाँ, custodians. So custodians में क्या है? Several custodians are also clearing members and clearing banks of the exchange, and they manage both funds and securities settlement. So they may be having twin roles, double role. They may be clearing member also, and they may be managing both funds as the securities settlement.
Yes.
An auction is resorted to when there are shortages in delivery by a seller broker.
Seller broker.
So in case there is a shortage, so naturally then open auction is done. So an auction is resorted to when there are shortages in delivery by a seller broker. This mechanism is utilized by the clearing corporation to fulfill its obligation towards the buying trading member. Thus, when the selling broker fails to deliver the shares, the clearing corporation through the stock exchanges system conducts an open market purchase by way of an open auction, and the shares bought through the auction are delivered to the buying broker, and adequate penalties are levied on the selling broker. So now let us have a look. So this portion which we have discussed today is of 4 marks. So for 4 marks, I think these 4 questions may not be sufficient. So let us have a look at some of the let me open MCQ on stock exchange. Let us see this. I think this file I've already shared in the group. I think now it is visible. So which of these is a function of the stock exchange? Role of an economic barometer, valuation of securities, encouraging investments and savings, all of the above.
All of them.
Which of these is the regulatory body for the capital markets in India? Answer is SEBI. So SEBI is the regulatory body for capital markets in India. How many companies are a part of Sensex? Stock Exchange Sensitive Index. They may even ask the full form of Sensex. How many companies are there? Anji, any other answer for this? So which of the following terms is not related to a stock exchange? I think we did this yesterday also. So KPO is not. KPO is a term which is associated with, say, call centers, knowledge process outsourcing. So this is not a term related to stock exchange. So when was Nifty established? Nifty कब established हुआ था?
96.
96 में हुआ था, right? A contract between a buyer and a seller entered on a particular date regarding a transaction that they will fulfill at a later date. So there is a contract between a buyer and a seller. They enter it on a particular date, but they'll say, okay, we'll perform it later. So this is known as what type of contract? इसको क्या बोलते हैं?
Future.
Forward.
हाँ जी, क्या बोल रहे थे आप?
हाँ, फॉरवर्ड बोल रहे थे, लेकिन हाँ ठीक है, स्टॉक मार्केट में फ्यूचर कॉन्ट्रैक्ट है, ठीक.
The first computerized stock exchange in India was, पहला कौन सा था इसमें?
NSE.
निफ्टी एंड सेंसेक्स आर कैलकुलेटेड ऑन द बेसिस, निफ्टी और ये सेंसेक्स का कैलकुलेशन होता किस बेसिस पे है?
Free float capitalization, I think.
Market capitalization.
फ्री फ्लोट ही आ रहा है इसमें।
Sir, what is a free float then?
Actually, market capitalization is basically, say a company has got say 100 shares, okay, and the market value of those 100 shares is say 500 rupees per share. So then market capitalization is 50,000. So this is the way in which market capitalization is calculated.
Okay, then free float means
Free float,
Free float
हाँ,
is available for trading.
okay.
So all shares might not be in, available for trading,
Yes.
I think.
acha. Next is, which of these derivatives does not get traded in the Indian Stock Exchange? The options are forward rate agreements, index options, futures, stock futures, and index futures. So these forward rate agreements, they are not traded in Indian Stock Exchange.
Yes.
So which of the following options is not available in India? Commodity futures, index options, index futures, commodity options.
Commodity option, I think.
Commodity options.
Yes, commodity options are not available. Which of the following statement is valid for mutual funds in India? Which of the following statements is valid for mutual funds in India? Entry load is allowed. Entry load means that at the time of entry, they can impose some expenses. Exit load is not allowed. Okay, you cannot charge at the time one wants to exit. Exit load is allowed in some cases. Entry load is not allowed. So which of these statements is valid for mutual funds? So how do mutual funds work? Suppose you want to buy 100 units. So the price is already available in the newspaper. The price is already available on the trading terminals. So besides that price, whether the mutual fund will be charging you something in addition to it, whether at both the times entry or exit, or at the time of entry only, or at the time of exit only, what is the situation? This is the question basically. So answer is exit load is allowed in some cases. Entry load is allowed. So exit load is allowed in some cases. So at the time of exit also, they may charge you something.
Yes.
The spot exchange rate is the exchange rate between two currencies for spot exchange rate. For future delivery, for delivery at a particular spot in future, for immediate delivery, none of these.
B.
Immediately.
For immediate delivery. So which of these markets allows trading of securities with less than 1 year of maturity? Global market, money market, capital market, transaction market. The answer is money market. The leading supplier, and we studied money market yesterday also. The leading suppliers of trading instruments in capital market are private corporations, government corporations, manufacturing corporations.
Government corporation. Government corporation.
The answer is government corporation.
Government.
The markets where the transactions are done through computers and telephones without any specific location are known as over-the-counter markets, capital counter market, past counter market, future counter markets. Over-the-counter markets. The Securities Exchange Board of India is not responsible for which of these?
C. Improving the answer.
Yes. Which term is apt to describe the payout made to shareholders representing their share in the company's profits? So because shareholders are entitled to something. So
Dividend.
In primary market, the property of shares that makes it easy to sell newly issued equity is called, क्या कहते हैं इसको? Large funds, increased liquidity, decreased
Increase liquidity.
Yes. The markets where securities instruments are traded directly between buyer and seller are known as
Secondary market.
Second rule. Primary rule.
directly है ना, directly हो रही है
Yeah.
buyer और
Yeah.
seller. In which year did the Sensex cross 5,000 point mark for the first time? ये तो चलो खैर इतना relevant नहीं है. Headquarter of National Stock Exchange is situated in which city?
See. Delhi.
Mumbai.
Promoter of the National Stock Exchange is?
Hmm.
ये सभी ने हाँ सभी ने मिलकर किया. Which of these trading individuals have a license from the SEBI to operate in commodity derivatives and equity markets?
Because it trading license. Number comedy. Brokers, clearing members.
So the answer is brokers and clearing members.
Okay.
The financial body that has asked intermediaries and companies to make regulatory payments in digital mode is
Financial body तो RBI ही है. RBI.
RBI.
answer is SEBI.
Maybe.
In which market can entities under probe for a severe violation seek settlement if they compensate investors for the losses as per the SEBI guidelines? सेटलमेंट कौन से में होगा, कहां पर सेटलमेंट, कौन सी मार्केट में सेटलमेंट होगा? कैपिटल मार्केट में. The answer is capital market. So which of the following statements is incorrect about SEBI? SEBI के बारे में ये कल भी क्वेश्चन था ना, तो it is a non-statutory body. This statement is incorrect
Yes.
because it is a statutory body. अच्छा. Which of the following might be reason for a stock market to lose value suddenly?
Arrest, attack, bankruptcy of a big company, fear of
All of them.
Which of the following is responsible for fluctuations in the Sensex?
monetary policy, fiscal, monetary policy,
All.
fiscal instability, all आ जाएंगे इसमें भी.
Over the life of a derivative contract, the value of the derivative increases, decreases, fluctuates. क्या होगा भाई? आपने डेरिवेटिव ले रखा है, ठीक है ना, तो अब वो डेरिवेटिव आपने जैसे जैसे उसका टाइम इट इंक्रीजेस ओवर द लाइफ ऑफ द डेरिवेटिव कॉन्ट्रैक्ट
फ्लक्चुएट होएगा.
हाँ, it will fluctuate with the price of the so-called underlying value of the contract. The forward exchange rate is the rate of exchange between two currencies, that is
Forward exchange rate is the rate prevailing today for immediate. यही होना चाहिए immediate delivery.
Prevailing today for future delivery.
right.
Okay, see.
Acha, which of these authorities supervise India's capital market in investment?
SEBI.
What is the stock exchange sensitive index total number of companies?
30. ये तो वही है.
हाँ ठीक है. Which of the below doesn't have anything to do with the stock exchange? ये भी हो गया KPO, ठीक है ना? When was the stock exchange Nifty founded? Nifty कब हुआ?
ये भी same 96.
हाँ. अच्छा. A dash is a contract signed on a specific date between the purchaser and seller for a trade that will be executed at a future date.
Future contract. Contract for
Repeated questions, sir. All repeated questions, I think. Repeated, I think.
तो अच्छा है ना, फिर तो बढ़िया है ना, आपके लिए रिवीजन हो जाएगा. अभी पढ़ा तो अभी तो आंसर देना चाहिए. हाँ जी. So India's dash was the country's first digitized stock exchange.
सर इसमें फ्यूचर कॉन्ट्रैक्ट फॉर द फ्यूचर और कॉन्ट्रैक्ट फॉर डेरिवेटिव इसमें डिफरेंस क्या रहेगा फिर? क्योंकि फ्यूचर कॉन्ट्रैक्ट को ही आई थिंक डेरिवेटिव कॉन्ट्रैक्ट ही कहते हैं।
हम्म, इसको थोड़ा और स्टडी कर लेते हैं, फिर डिस्कस करते हैं इसको।
हाँ जी,
हाँ, फ्यूचर्स एंड ऑप्शंस होता है ना बेसिकली।
हाँ जी, हाँ जी, वो डेरिवेटिव बोलते हैं ना उसको, इक्विटी एंड डेरिवेटिव्स।
हाँ हाँ, तो वो ये कह रहा है कि इट इज ए कॉन्ट्रैक्ट साइंड ऑन ए स्पेसिफिक डेट फॉर अ ट्रेड दैट विल बी एक्सिक्यूटेड एट अ फ्यूचर डेट।
हाँ, जनरल लैंग्वेज में तो इसको फ्यूचर कॉन्ट्रैक्ट ही बोलेंगे, बात तो ठीक है ये। पर मैं ये कह रहा हूँ कॉन्ट्रैक्ट और डेरिवेटिव में फिर डिफरेंस क्या हो जाएगा?
डेरिवेटिव में तो फ्यूचर के अलावा भी चीजें आ सकती है ना, ऑप्शन भी आ सकते हैं। डेरिवेटिव मेरे ख्याल से ब्रॉडर टर्म नहीं है।
कह नहीं सकता, अब ज्यादा मैंने भी इतना ज्यादा
कोई
डिटेल
बात नहीं, कोई बात नहीं, थोड़ा देख लेंगे इसको। हाँ, ग्रुप में डिस्कस कर लेंगे, थोड़ा सा और कर लेते हैं इसमें। अच्छा, कौन सा फर्स्ट डिजिटल स्टॉक एक्सचेंज कौन सा था इनमें से? ये कह रहा है एनएससी। ये निफ्टी और सेंसेक्स किस पर डिपेंडेंट है? कैपिटलाइजेशन बेस्ड ऑन, ये भी हो ही गया हमारा, ठीक है ना। विच ऑफ दिस डेरिवेटिव्स आर नॉट एक्सचेंज ऑन द इंडियन स्टॉक मार्केट्स, ये भी हो गया है ना। फॉरवर्ड रेट एग्रीमेंट्स, ठीक है। इन इंडिया विच ऑफ द बिलो ऑल्टरनेटिव इज नॉट एक्सेसिबल, ये भी हो गया था हमारा, है ना। और कमोडिटी ऑप्शन अवेलेबल नहीं है। ये अच्छा, ये भी हो गया हमारा। क्या आंसर है बताइए, अभी तो किया था ये वाला क्वेश्चन। विच ऑफ द बिलो स्टेटमेंट्स अबाउट म्यूचुअल फंड्स इन इंडिया इज करेक्ट?
In some instance, exit load is
Yes,
negative.
yes, हाँ वही लग रहा है। C is the answer. Spot exchange rate is the rate at which two currencies are exchanged for the purpose of, अभी अभी किया है ये।
For instance, negative.
फ्यूचर
Which of these exchanges permits you to exchange securities having a maturity period of less than 1 year? अभी अभी किया है, just 5 minutes before.
मनी
Marketplace in which instruments of securities are exchanged directly between the fund trader and the purchaser, क्या कहते हैं इसको? अभी किया है।
Directly, it is a primary.
Primary market.
प्राइमरी।
लंदन स्टॉक एक्सचेंज का स्टॉक मार्केट इंडेक्स को क्या कहते हैं?
कुर्सी।
नेशनल स्टॉक एक्सचेंज का हेडक्वार्टर कहाँ है?
Mumbai.
अब याद हो जाएगा धीरे धीरे। इन द कैपिटल मार्केट द प्राइमरी सप्लायर्स ऑफ ट्रेडिंग इंस्ट्रूमेंट्स आर, ये भी कर लिया था, एंटरप्राइज ओन्ड बाय द गवर्नमेंट, ठीक है ना। अच्छा, ये भी कर लिया था हमने, अभी वी जस्ट डिड इट नाउ, अभी किया था नहीं। तो भाई आपके जो रेजिंग द अर्निंग्स ऑफ द कंपनी शेयरहोल्डर, इट इज नॉट द कंसर्न ऑफ द सेबी। सो व्हिच टर्मिनोलॉजी बेस्ट डिफाइंस द पेमेंट्स पेड टू शेयरहोल्डर्स, ये भी कर लिया था, डिविडेंड था इसमें ना ऑप्शन। Which terminology best defines the payments paid to shareholders in exchange for their share of the company's profits?
ये आंसर होगा सर, सी होगा।
हाँ, सी ही होना चाहिए।
No.
चलो, features of shares in primary market that make it very easy to sell recently issued securities is known as
लिक्विडिटी इंक्रीज। ये ऑल था इसका।
हाँ। Which of these merchants is licensed to deal in equity market and commodity derivatives by the SEBI?
ए बी डी, डी आंसर है।
Right. The financial institution that is a middleman enterprise to make regulatory payouts in digital format, ये भी अभी किया हमने, सभी था ना इसका आंसर।
हाँ जी, हाँ जी।
Which markets can entities under scrutiny for a gross breach pursue a settlement provided these payouts? ये कौन सा था?
कैपिटल वन।
Right. Which of the below statements regarding the SEBI is not correct?
नॉन
CC. Which of the below could cause a stock market to abruptly lose its value? ये भी अभी किया है हमने।
डी
All.
हाँ, which of these factors derive the sensex to fluctuate?
ऑल
All.
Rate of exchange between any two currencies, that is dash, is known as forward exchange rate.
सी
Fixing the price today for delivery future.
Right, C is the correct answer. Right. The worth of a derivative contract throughout the terms of the contract. ये भी अभी किया हमने। हाँ,
सी
right. अब देखो ये करने से हमें क्या है कि we got some basic idea and we got some questions also. We got at least 20-30 questions. So let me share with you another MCQ. ये तो ऑलमोस्ट सेम ही है जो हमने whatever we have discussed. This rolling settlement is a new concept. Let us see this. So a rolling settlement is one with the trade is, ये मेरी screen share हो रही है नहीं हो रही? नहीं हो रही।
No.
नहीं हो रही सर।
ठीक है, ठीक है। Now I think it is visible.
Yes sir.
Yes. Yes.
So let us see the types of settlement. The first is the एक तो on the spot settlement. So this type of settlement is carried out immediately. Then there is forward settlement and then is rolling settlement. So let us understand this concept of rolling settlement. A rolling settlement is one in which the trade is settled in the days following the trade. So trades are settled in T+2 days with this sort of settlement, which indicates the deals are closed after the second working day. Sunday, Saturday, bank holidays, and exchange holidays are not included in this time frame. Yeah, this also we have seen. Acha, for dividend seeking investors, this is important. The equity settlement day is important. If the buyer wants to collect dividend from the company, he must settle the trade for a profit before the record date. Settlement cycle. You can go through this also. Can anybody tell me what is the difference between clearing corporation and clearing bank? But there is a difference between clearing corporation and clearing bank. What is the difference? Because if you go to this page number 51 of the study material, it says clearing banks, they act as an important intermediary between a clearing member and the clearing corporation. So it means there are three entities involved. One is the clearing bank, another is the clearing member, and then is the clearing corporation. So clearing corporation and clearing bank are different. Similarly, clearing member and clearing bank are different. So every clearing member needs to maintain. Now, first, let us understand what is a clearing member. Clearing member कौन है? बताइए भाई, इतना रामायण पढ़ लिया हमने भाई, जिसको कुछ देना लेना वही क्लियरिंग मेंबर है. इज द पर्सन हु इज मतलब who has to pay or who has to say meet his obligation, basically that is the clearing member.
ट्रेडर ब्रोकर जो है
ब्रोकर बेसिकली.
So basically if we go to page number 50, it says clearing is a process of determination of obligations, after which the obligations are discharged by settlement. A multilateral netting procedure is adopted to determine the net settlement obligations of the clearing members. Accordingly, a clearing member would have either pay-in or pay-out obligations for funds and securities separately. So settlement is a two-way process which involves transfer of funds and securities on the settlement date. And clearing corporations, they have also devised mechanism in India to handle various exceptional situations like security shortage, bad delivery, company objection, auction settlement. So how many clearing corporations are there in India? Clearing corporation कितनी है?
3.
हाँ, 3 है. इनका क्या रोल रहता है? What do they do? करते क्या है ये? Clearing corporation, what is their role basically?
जो आपने अभी बताया.
हाँ, their role is given on page number 52. It says role of clearing corporation. So when a trade occurs on the stock exchange, it is a legal contract between the buyer and the seller. So if there is a default, the counterparty to the trade will have to bear the loss. So clearing corporation, they act as some say counter guarantee, counterparty to every
Yes.
contract. So clearing corporation ensures that members meet their funds security obligations. And who are the members? Basically, those who are trading on the
Clearing
stock
members.
exchange. So it acts as a legal counterparty to all trades through the process called novation. This process is called novation. So every time there is a contract, clearing corporation comes into picture. It acts as a counterparty. Thus, clearing corporation becomes the buyer to every seller and seller to every buyer. If there is a default in this scenario, clearing corporation, being counterparty, is responsible for ensuring the settlement, thus managing risk and guaranteeing settlement to both the parties. In a multilateral netting scenario, when a default occurs, it is difficult to unwind the trade to find the original counterparty who will have to bear the loss. The process of novation addresses this risk because through novation, clearing corporation enters into every contract as a counterparty. In India, in the equity segment, there are 3 clearing corporations: NSE Clearing Limited, Indian Clearing Corporation Limited, and Metropolitan Clearing Corporation of India Limited. I think we can stop here, and then tomorrow, what I will do, and which each of us will try to do. First of all, let us develop a flow chart for whatever we have discussed, because it is of 4 marks and we have to give it adequate importance. So till now, we have covered 12 marks paper, including today's session. So we should have sufficient MCQs on it for practice purpose. So I've tried to give you some MCQs so you can find out more MCQs also. Because whatever is given in the NISM syllabus, that is very limited, but we should study beyond that.
Okay.
So tomorrow, same time, same jagah.
Okay, sir.
Okay.
Thank you.
Ajay.